Hello there. My name is Beverly Kersmerzik with Oasis Wealth Design here in Guelph, Ontario. Welcome to our workshop entitled Life Insurance Need versus Want. Before we dive into the material today, I'm going to invite you to watch a short video about what Oasis Wealth does, who we are, and why we are here. Take a quick look and then we'll get right into the material.
Who is Oasis Wealth? We are a family business that has been serving Guelph and the surrounding area for over 30 years. This is Tony, owner and founder, and this is me, Beverly. We are a no fee-for-service office offering full wealth designs. Together we focus on your wealth, not just your financial status. You see, financial planning focuses on your net worth, the bottom line. We focus on wealth designs, which capture your entire state of well-being. Let's address the elephant in the room. What's our business model? We are life insurance brokers and referral sources for many different products and solutions, including insurance, investment management, everything from RSPs to TFSAs, as well as banking solutions, debt solutions, and group benefit strategies. We believe that products, however, are never the solution. Let me put it this way. Most of us, somewhere in our home, have a drawer full of miscellaneous items that at one point were useful and valuable to our lives. However, over time, they have started to collect dust in what we often refer to as our junk drawer. Most new clients we see have a financial junk drawer, a filing cabinet, or perhaps just a box of all well-meaning products that at some point were very useful and valuable. However, over time, the way we make decisions and the way we organize often lead to confusion and inefficient use of your hard-earned dollars. Consider playing a game, such as chess or Monopoly. How would the game go if you had no game board? Or what about no rule book? How would you know who is winning or losing? The same can be said for our finances. We often have a lot of great pieces, but no game board or rule book. And this is why we use a game board to design your well-being. Using this game board, you can see every financial decision you have made and will make on one page, clear and simple. The model consists of 5 sections: cash flow, debt, protection, savings, and growth. Every financial product you own fits on this one-page model. This allows every financial decision you make to be organized, coordinated, and integrated. Here is another pitfall. Even with the best organization, when's the last time you had all of your sources of advice in the same room at the same time? Never. See us in the middle? That's your personal CFO. We come alongside your family, and with the game board, we work together to always find the best design given the resources at hand. But you won't pay us a hefty salary to do it. At Oasis Wealth, we don't just settle for needs and good enough. We believe in your maximum potential. We always seek to maximize your protection, maximize your opportunity for growth using multipliers, and ultimately maximize your guaranteed retirement income. Why? Because when it comes to your finances, failure is not an option. So upgrade your advice today with Oasis Wealth, where your state of well-being is our top priority.
And welcome back. All right, so let's dive into our material today. I'm going to put myself a little smaller over here. All right, let's get into it. I assume if you are watching this workshop today that you have some questions either about what life insurance is, the different varieties, why we need it, why we may want it, and I'm hoping that those questions will be answered through this time together. We'll also be going over how you would use life insurance in retirement because it's not just for the young. If you have any questions or any comments throughout the workshop today, feel free to make a note below the video, or you certainly can contact us. All our contact information is listed on the account here. So first of all, let's go through the basics of who's involved in a life insurance contract. So a lot of times there's usually only 2 parties or 3, but there can be up to 4 parties in a contract. So the first party that everybody knows is the insurer. So that could be the company that you're dealing with, Manulife, Canada Life, Equitable Life, whomever it may be. Next party we have is the life insured. So this is the person who's going through the medical information. They're the ones who they're answering the questions about and who the risk is being attested to. That person typically and often is also the owner. The owner of the policy is the person who has rights to the policy, who usually pays for the policy, and a lot of times they're the same person. However, there are occasions, 2 in particular, where they will be different. One is if the life insured is a child. So we do use life insurance for children as a whole strategy of saving for the children's future, as well as just setting them up. And in those cases, the life insured would be the child and the parent or the grandparent would be the owner. Another situation where this happens, where it could be in a corporate world, where the life insured is on, let's say, the owner of the company, but the owner of the policy is actually the holding company or just the company in general, so that we have some ability to flow cash flows through the company and the owners. The last party to an insurance contract is the beneficiary. So obviously, whoever would get the proceeds should the life insured die. So again, that owner and beneficiary could be the same person if the owner is not the one who's insured. So again, in that child situation, where the life insured is the child, but the parents own it, and the parents could be the beneficiary, where if the child passed away, the parents would be the one who gets the money. Clear as mud. Let's move on. There are, in essence, 2 categories of insurance, and that's really it. You have term insurance. So just as it says on here, term insurance is a type of a life insurance that provides coverage for a certain amount of time for a specified term of years. If the insured dies during the time period specified in the policy and the policy is active or in force, then a death benefit will be paid. So in a term insurance policy, it has to be in force in order for it to be paid out. These have expirations, they don't last forever. So let's go through the details of those. And there's no cash, and we'll explain what that means and why that's important. We typically see people using these 3 types of term insurance, and even then, mostly we're using term 10s and term 20s. So, but the language is the same throughout. So premiums for a term 10, so your premium, which is the cost on a monthly basis or annual, it is level for 10 years, and then every 10 years, the premium goes up and is then level again for that next 10 years. It will continue to do so until age 85. At age 85, all term insurances expire. You don't have an option after that. If you haven't made any decisions, it will end. Term 20, same idea. For 20 years, the premium is the same, so you're locking in your premium for longer. And then the next 20 years, it goes up and it stays level for another 20 years. Term 30, same concept, okay? There is an option of a term to 100. So this is typically marked as permanent insurance because we typically think of a living to age 100 as probably our life expectancy, but it's not unknown and uncommon to be living past 100. So it can be considered permanent if you know you're going to die before 100, but we don't know that. So it can be used for estate needs and burial expenses. However, this policy does cease to exist if you live past 100. So pros and cons there. Options with a term insurance. So if you currently have a term insurance policy, it would be beneficial to take a look to make sure that your policy has these type of options. Most solid companies with flexible products should have them, but it's valuable to know what your options are, okay? Number 1, exchange. There are a few companies that give you the ability to exchange a term 10, so one that goes up every 10 years, for a term 20 within the first 5 to 7 years, depending on the company, without going through all the medical questions again. Why is that important? We typically use this strategy a lot when I've got young families in who have a lot of income to replace when they're young. However, cash flow might be strapped between parental leaves, between daycare expenses, soccer, ballet, whatever. The cash flow is not necessarily there for a term 20. So what this option allows you to do is to get a term 10, which is a lower premium option. And then in the first 5 to 7 years, as cash flow improves, we can exchange that term 10 for a term 20, regardless of your health. Then at that point, the term 20 starts then. So the 20 years would begin at that point, and then you're locking your premiums for longer. This can be valuable because most individuals do not own a mortgage for 10 years when you're young. They're typically amortized over 25 to 30. So especially even in the needs aspect of covering a debt, we need to be conscious that 10 years is not going to be enough. But cash flow might restrain that. That might be the way we go about it. Second option is a conversion. Now, most solid companies that have permanent products on their shelves will give you this option. So when you're looking at your options for term 10 insurance or any type of a term insurance, please ensure that you know what your conversion options are and that the company you're working with is not just the lowest premium. We need to ensure that it has flexibility for something permanent should you want it in the future. So conversion, what does this mean? It gives you the flexibility to convert all or part of your term policy to a permanent life insurance policy anytime the policy is in force. There's no time limit, unlike the exchange. So if you have a term 20 policy, even if it renews for another 20 years, you have any time that those premiums are being paid up in that term, you can exchange all of it or part of it for a permanent product. For example, if you have $500,000 of a term 20, and in year 5, you decide you want to exchange $100,000 of it for permanent. That would leave you with $400,000 term still and $100,000 permanent. So the entirety would still be the same amount of death benefit, but we're exchanging it, we're converting it for part of it to be permanent. The third thing to note, and we've touched on this a little bit, is renewals. So it's the opportunity to extend your policy for a similar term without proof of insurability. The key here is that you don't actually have to do anything. If you have a term 10 or a term 20, it will automatically happen. And this is a good and a bad thing. It happens because in an insurance contract, and until you get to that age 85 where it expires, and that's in the contract, they legally have to keep that in force until you say no. So every 10 years, your premiums will go up whether you told them to or not. It's part of the original contract. So you need to be aware of that. You need to be watching when these things come up for renewal. At that point, the term 10 will renew to the next bracket, and term 20, same thing. Depending on the policy, you can see it go up, maybe double, sometimes 4 or 5 times the original cost. So you want to be aware of when these renew and what your options are. The value in a renewal. If you are sick and life expectancy is not in your favor, shall we say, and you know that your term 10, if you just let it renew, and even if you pay 1 or 2 more years of premium because you have 1 or 2 year life expectancy, it would be worth paying the higher premium for that 1 or 2 years to renew rather than canceling it and your family not getting anything. The value in the renewals is that they automatically keep going until age 85, irregardless of your health. Okay, so those are the circumstances where they would be useful, and we have seen them be used. Okay. Permanent. So term is one spectrum, permanent is another. Permanent insurance provides lifelong protection, as it would state, and it also has the ability to accumulate cash value on a tax-deferred basis. Unlike term insurance, a permanent insurance policy will remain in force as long as you continue to pay your premiums. There's no expiry on this, not like an age 85 or even age 100. The other value here is people need to understand on a term policy, if you miss one premium, you're given 30 days notice, and if you don't pay up, it's gone. And you have to go through all the medical underwriting to get it back. Under a permanent policy, there are multiple provisions so that if you miss a premium or something happens to your cash flow that you cannot provide for that premium for a few months, there are options and fallbacks provided in the policy. That is key and a huge benefit when it comes to this, because life doesn't go in a straight line. Okay. Underneath that permanent insurance umbrella, there are really 2 sub-umbrellas, we'll call them. Okay. Non-participating and participating. What this means, non-participating means that you had a death benefit and some guaranteed cash, which again, in the policy, which again help to prove if there is a time where you can't pay premiums for a little bit, they'll use those cash, those type of things. You have options to either pay for life or for 20 pay. So you can have the premiums only set for 20 years, premium stop, but your coverage is for life regardless of how long you live. These are typically the non-medical options. So there are quite a few non-medical companies. The one you'll typically see in the news is Canada Protection Plan, or CPP. And those are great options for anyone who's been a cancer survivor, has MS, has diabetes, has heart conditions. All of those are insurable under these non-medical plans, meaning the questions are very minimal. And even cancer questions, even someone who has been in remission for 12 months has the options. The downside here is that these non-participating insurance policies, while they are permanent and they are fantastic for long-term planning, they don't have that opportunity for growth, okay? On the flip side, participating, what this means is that when we have an insurance policy that is participating in the company, you essentially own a piece of that pie. So I'm going to show you an illustration, but what this means is that that cash that is in your policy, it's like dividends within an investment. It's not the same, but it's the same concept that there are return premiums, there are cash that is coming back to you that you are able to either grow your policy, multiple different options within there, and we're going to go through those. So participating has guaranteed and growth cash value. You have other additional options when it comes to your pay options. Under participating, we can do it as early as an 8-year pay up, and this can happen for people that are very close to retirement or business owners who want to just pay for it and then be done. 10-year, 15-year, 20 years, there's multiple options, and there's plenty of options even midway that, again, we can use that growth component to stop paying. Guaranteed for life as long as premiums are paid or cash in the policy can continue to pay. And the big value here is that you're not just buying a death benefit, you're participating in the growth of the company. Same kind of reason that someone would buy a stock in a company, they're participating in the growth of that company. Again, another level of umbrellas here. Under that participating permanent, there are these two words, two type of policies, universal life and whole life policies. Well, the concept is mainly the same, the structure of them and how the individual is a part of the policy is very different. In a whole life policy, so this side of the screen here, deposits go in, you get your insurance, you die, you have your insurance. But then what happens is that part of the money that you're putting into this insurance company is actually going into their investment, into the growth of their company. So the money that you put in, obviously, they will pay out people that died. They'll pay the administration to handle all of the policies, all those expenses that come with running a company, and then otherwise they handle the investment. So the investment component in a whole life policy is managed by these multi-billion-dollar insurance companies. The value there is that they have access to investments and type of investments and type of real estate and type of foreign investments that you and I just cannot access. So their ability to diversify in their portfolios is much higher than what we might be able to do. 2, there is no investor behavior involved. This is the big key. When you have something to deal with a guaranteed death benefit that you want on the books, we don't want to be playing with it. We don't want to be playing Russian roulette in the market with it. So the value here is that they manage the money. On the flip side, under the universal life, it's the same concept, but it's unbundled, okay? It's essentially like a term insurance policy with an investment that you get to pick. Now, the problems here can be if you pick an investment that is up and down significantly, that means your cash in the policy is up and down significantly. And at that point, we've kind of lost the safeguardness that we want within that policy. Under a whole life policy, they smooth out their returns, so they may not pay out the dividend the next year as high. Your cash value might not go up as much next year if the market's down, but it won't go down. So we have to weigh the pros and cons. A universal life just has a lot more investor input, which can be great. You can see a lot more opportunity. However, it could also be very dangerous because we know investor behavior, okay? So two different kind of realms. When we are continuing to talk in our presentation today, we're mainly going to be focusing on the participating whole life, where we let the insurance company manage the investment, okay? So here is how whole life works. Millions of people and corporations around the world own whole life insurance with trillions of dollars paid into it as a foundation, okay? It is popular because it helps protect your economic life value, because most people need some kind of life insurance to replace their income, pay off debts, all those type of things. But it also provides additional benefits. It's not just a cost for a possible benefit. Few different benefits: immediate legacy for their heirs and charities, okay, that death benefit aspect. Guaranteed premium payments, no going up every 10, 20 years. Level. In fact, usually can go down or you stop paying for sooner, okay? Guaranteed cash, so there is guaranteed contractual cash in the policy that can be used to pay your premiums, to give you a little premium break, to use in retirement. Tax advantages, so again, that cash that is built up in an insurance policy is tax deferred. So a lot of reasons why people put money into an RSP is that it is tax deferred. Or they invest in real estate, it's tax deferred. Same type of principle when it comes to the cash within here. In fact, there are ways to access the cash completely tax-free, okay? But there's no minimums. Oh, sorry, there's no maximums into your contributions like a TFSA. This is a big one, creditor protection. Did you know that your tax-free savings accounts and your RSPs and your house and your car are all susceptible if you get sued for more than what you have in liability, or if you go bankrupt? Listen, life happens. So in Ontario, current laws provide that so long as you did not buy the insurance policy for the very sake of hiding money from a pending creditor issue or bankruptcy issue, there is creditor protection on that. So if you get into a sticky situation and you hit someone with their car and they sue you for more than your liability is on your auto insurance, then the cash within these policies is protected. Opportunity for retirement income, we'll discuss this, but that cash within there can be just as effective as a retirement income, as a TFSA or an RSP. So this is kind of the building of the whole life. Now we mentioned there's growth in there, okay? So with the growth, just like if you had a tax-free savings account that you were investing into some stocks or some bonds, there might be interest and dividends being paid out. Now the default on almost all type of investments is reinvest the dividends. Same concept here. There are dividends that are being claimed by the insurance companies year after year, and those dividends, you get multiple options what to do with them. So here we'll go through them here. Number one, paid in cash. So you could take that dividend, take it in cash. Now there is taxes to pay on dividends, so this is where it's maybe not the most tax efficient, because the tax rates on dividends depends on your situation. However, it could be a very valuable cash tool as an additional retirement income in retirement. We'll see about that. Reduced premium. These dividends, they will grow every year. So what you can do, instead of having it reinvested, you could say, don't pay me, keep it in the policy, and just reduce my premium every year by the amount that the dividend is. And therefore, over time, your premium will go down, 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 and then disappear. Purchase paid up addition. So this is that whole idea of reinvesting the dividends, and it's a default that essentially most of them we use, okay? So this means that that dividend that you have that year will go back into the policy and buy you a little more life insurance. So every year your death benefit goes up, your cash value goes up, and it's kind of keeping up with that inflation, keeping up with the way life goes, but it also is protecting. It's that tax deferred benefit that if the cash stays, that dividend stays in the policy, it remains tax deferred. Number four, you could accumulate it at interest. So we could operate it as far as like insurance, side account, and that side account could accumulate an interest. Purchase 1 year term life insurance. That's not really an option too frequent up here in Canada, so we won't go through too much of that. And 6, paid loan interest or loan balance. So accessing cash in your policy one of the best ways to can be the best ways to do it is to access it as a loan. You have the option of taking a loan on that cash without any financial underwriting or anything like that, like you would have to for your house. So the dividends that you would claim every year could go back into the policy to pay for that loan interest. Therefore, you don't ever actually have to pay back the loan. Okay? Temporary versus permanent. Why we need insurance, why we want insurance. Let's talk about that. Why do you need it? Mortgage or other debts. If you have a mortgage, you have a responsibility to pay that mortgage. If something were to happen to you and your income is gone, who is going to pay that mortgage? It's a very simple one. Most people understand that. To replace income to your spouse. And we're going to go through an exercise that will show you exactly how much you're worth. But a lot of times we're not replacing the full income that our spouse is dependent on us for, or our kids are. Education fund and legacy for children in the event of death. Essentially just funding it with life insurance, because if something happens to you, you want to make sure they're taken care of. And estate planning. This might be a need where you have a need to have a specific amount for burial expenses or those funeral bills, things that you know are going to come. And again, a lot of times that's where that non-medical comes in for that age group, where you can simply have something on the books that is guaranteed for those final expenses. Now, why would you want insurance? Because if we could drive around without insurance on our car, we might. If we could certainly pay less and know that we weren't going to have an accident, we certainly would. Why we want insurance is a very different conversation than why we need it. We want insurance to enhance our retirement spending. We're going to go through an exercise to show you why. But essentially, we have an insurance as another bag of money for retirement. Okay? Tax-efficient cash growth. We talked a little bit about this. The cash within that policy, so long as it stays in that policy, grows tax-deferred just like an RSP. Non-market correlated assets. So again, this cash value that is sitting in an account, essentially sitting within your life insurance policy, it does not go down. What happens to your funds in the markets? They go up, they go down, they go up, they go down. That's the nature of the stock market, and that's okay. However, especially in retirement, it is imperative to also have a bag of money that is not dependent on the market going up and down and stressing you out, and all of a sudden, Business News Network, the BNN, becomes your favorite channel in retirement. So having another bag of money in this cash value that is not correlated to the market is key. Guaranteed cash building. So there's guarantees within there. Where in any contract besides a GIC that only lasts for a certain amount of time is a guaranteed cash that you can make on your money. Lifetime benefit. So again, having that benefit on the books, no matter how old you get, is a huge want for a lot of people. Let's think about it this way. Why would an individual move from renting to owning a home? Would it cost more? Would it cost more time and headaches than renting would have had? When you're renting, you don't have to worry about the water heater. You might have to call the landlord, but you typically don't have to worry about the lawn. You don't have to worry about the furnace filters, all that stuff. And yet at the same time, we have this striving to get to home ownership. Why? Because they want equity in their home. They want a piece of the pie, and they want to know that the money that they're putting into a product, like a mortgage, like a house, is going towards their betterment and their financial wealth growing. Same idea with temporary or term insurance versus permanent. Temporary, you're renting it. If you don't die in that time period while it's in force, it's just been wasted money. Permanent is an equity stake in your ability to also kill two birds with one stone. Have a death benefit for the things we need, and have that cash and those permanent values, the equity into our own selves in the sense of a permanent insurance product. So same kind of concept from going from renting to owning. All that to say that temporary is insurance that you need. Permanent insurance is a type that you want. And once you understand exactly how it works, it becomes quite a vital tool in anybody's wealth building. Let's go over quickly the other options and benefits that would be available to you in most insurance companies. most of the policies. Disability waiver. This is key. We try to put this on every any policy that we can. This allows you, if you go on long-term disability because you've been hurt, injured, you got sick, cancer, whatever came about, the insurance company, so long as you were considered disabled, the insurance company will continue to pay your premiums and fund your life insurance either until you're off disability or you pass away. In what other world does the bank provide the funding into your RSP or your tax-free savings account when your income has gone down and you're on disability? No one else will do that. So it can be a huge piece of the puzzle, because if someone is disabled, they've been hit, and life just hit them, are they closer to life expectancy? Or did their life expectancy just triple and now they have a chance of living to 105? Typically, as their life expectancy has lessened, so that need for that final expenses of life insurance becomes more potent, but their income has gone down at the same time and they can't afford it. So this provides for that gap of keeping the necessities in force without affecting your cash flow, which is already going to be cut at that time. Okay? Accidental death. Now, accidental death, you can add this to any type of policy. This would mean that if you died by means of an accident that was completely fluke, some sort of random act of chaos, then there would be additional benefits to pay. It's a very small premium for those, but the likelihood of them paying out, most deaths are not considered accidental. So it can be a lost cost. Critical illness. What is your game plan if you get cancer or you have a heart attack or a stroke? Most people don't consider those things. On a life insurance policy, critical illness can be a standalone policy in itself, which we'll talk about in another workshop. However, you can add it as a rider onto a life insurance policy, which can be more cost effective depending. And this allows that if you got any number of illnesses, cancer, heart attack, stroke, lost a limb, that they would pay you a lump sum, tax-free, that you could use however you see fit. So it doesn't have to go towards medical treatments. It could go towards Disney, whatever kind of worked. Could also go towards, improvements on the house. Also, a wheelchair became a necessity. So this critical illness is a rider you can add on that you can add it on to already the medical that you're going through for a life insurance policy. Guaranteed insurability. What this means is, and we use this a lot on children. So for instance, if you have a child and you buy $100,000 of life insurance on them, what you can do is, for pennies on the dollar, you can add guaranteed insurability, that they are allowed to add $100,000 at age 21, another $100,000 at 25, 30, 35, 40. These opportunities in their lives to buy more insurance as their need for that, when they get a mortgage, get a house, they get a family, they are able to acquire life insurance under that contract without having to go through medical insurability. Personally, in our household, 2 people in my household, and it's only a household of 4, are uninsurable. So I was thankful that I was able to get this guaranteed insurability on my daughter, who is insurable, because as she gets older, at least she has that option to add on. Heaven forbid she ever contract any type of disease in her childhood that won't affect her future insurability, okay? You'll think about these things, but in our household, we have a diabetic, and that means that as we decided we started to build our family, our insurance options were very limited. And had we had a guaranteed insurability, we'd have a lot more access to the death benefit that we need to replace income in our family without questions about diabetes, okay? Finally, child rider. So if you are an adult and you have children, you have the option of adding anywhere, usually it's around $5,000 up to $30,000 per child, onto your insurance policy. No one wants to think about kids passing away. Do not get me wrong. However, it is a little rider that you can add that would give the parents burial costs, those type of things, should anything happen to the kid. Other benefits that you don't pay for, they just come with some of these insurance companies, especially if you have a young family. We really need to talk about these ones. Orphan benefits. What happens if both parents pass away is that a lot of times the guardian and the trustee are the same person, but sometimes it's not. Sometimes the person who's going to be the guardian that takes over the kids is not the same person that's been designated the trustee for the life insurance or in the will that manages the money. When that happens, not that we ever want it to be, but it can be a battle for the guardians to tell the trustees, I need some money for these kids, just for daily living and for all the diapers and all this stuff. And the trustees reluctant to relieve over the money. There can be a little bit of an awkward situation there. One of these companies, a few companies that we deal with, offer orphan benefits. So if both parents pass away, there is $900 a month per child that the guardians get to accommodate for living expenses. What that allows them to do is to tuck away the life insurance death benefit that they received for the kids for later and have money immediately to provide for those day-to-day expenses. Huge benefit. Children's scholarships. My sister just got one from one of these insurance companies, actually, where they will grant up to $2,000 per year for the 4 years of your university, and a lot of them are based more so on community service hours than grades, which is key. So there's scholarships to be given away if you have a policy there. Community free events. So we personally have hosted a few. We've done a storm game. We went to the Lego Movie 2 in February. So there's free community events that you get invited to. And volunteer opportunities. There's plenty of, pack sanitary bags or pack, Christmas child's shoe boxes. Lots of opportunities to give back to the community with these companies. How do we fund insurance? So let's get away from the ins and outs. Those are all kind of the ins and outs of what you can do with an insurance policy. Let's talk about how do we get the money into it, okay? Term insurance, in our world of thinking, term insurance comes out of cash flow. So in our world, we deal with cash flow. We do cash flow analysis and take a look at what's going in, what's going out. And term insurance is an out-of-pocket cost. It is a cost to having a family or being married, and it should be treated as such. It should be an item line just like your home and auto insurance. However, on the flip side, participating permanent insurance is part of your wealth building. That would count towards your savings. You're building wealth, you're giving yourself a better opportunity for your spending in retirement. So it's part of your wealth building. So when I look at an individual's wealth plan, we always look at how much their savings rate is, and the money going towards participating permanent insurance would be part of their savings rate. It is not a cost, it is a wealth building. So let's talk about this whole idea of cost versus wealth building. Let's look at the premium. For a 35-year-old non-smoker, a 10-year renewable and convertible term, so again, you want to watch for those terms because they tell you that you have options. For $500,000, the annual premium is $289. But by the time year 11 kicks in, so when it renews at year 11, it jumps up to almost $1,800 a year. Okay, so jumps up, 4 or 5 times? A 20-year term is, for the same amount, $500,000, is $389. So for $100 a year more, you're locking in your premiums for twice as long. Participating whole life on a 20 pay, so you only have to pay for 20 years, and the benefit stays on the books for life, but it's set for 20 years. Now that comes in at $11,600. However, at what point do you see that the term also gets up to that amount? No one's going to pay for term at that amount because there's no guarantee that they're going to die before 85, okay? Let's look at what it means. Terms are costs. Whole life is a wealth building, and let's see why. Here's a summary of the premiums. So in a whole life situation, you only pay for the 20 years and then your premiums stop. There will always be a point where the sum of premiums in a 10-year term and a 20-year term end up passing how much you would have paid for a whole life if you end up needing to keep that in force and keep renewing it, okay? Cash value comparison. So you get what you pay for, is what I'm going to preface this with. A 10-year term and a 20-year term have zero cash. You are only paying for the death benefit. If you don't die, you don't get nothing, okay? Valuable tools, not valuable long-term tools, okay? Whole life cash value starts off small because there's the whole risk agreement on there, okay? But look at all these cash values as they continue to grow, the money that you've put into that policy, okay? 10-year term death benefit also 10 to 20 year term best death benefit, it never grows. Unless you go to buy more, it does not grow. And $500,000 in 20 years is not going to spend like $500,000 today. Am I right? So the other aspect here is whole life insurance, the death benefit, because those dividends are going back into the policies, just like reinvesting, continues to grow every year. You notice over 20 years, it almost doubles. And that's typical for most insurance policies here on the whole life side. So again, you get what you pay for. These are cheaper, but not only does the death, do the benefits stop, you're not guaranteed to get anything back out of it, but there is zero cash in it. We get what we pay for. Why buy term? Here's an alternative investment analysis, okay? Someone tells me, yeah, but if I take that money and I invest it into a tax-free savings account, I can get better rate of return than in the cash value. You may be right. You may be wrong. Let's take a look at it. Net accumulated at 5%. If you had taken that money that you would have put into a whole life policy at $11,000, you put it into a tax-free savings account, and you get 5% rate of return rate year over year over year. That's after fees, that's after expenses, that's after all that stuff. These are the numbers you would get. If we notice here, cash value of life insurance, by the time we get to year 2025, the cash value actually starts to outperform the tax-free savings account. Oh, and by the way, your death benefit is up to $1 million now. So yes, you may be able to get more in the market, but let's compare them a little bit. Which one has more probability of success? So in a tax-free savings account, will they fund it for you if you get disabled? If you get disabled, will they throw that 11 grand in a year? Nope. Cash value, they will. If you die and you have put $11,000 into a tax-free savings account, what does your family get? $11,000. You put that into the whole life policy, how much does your family get? In our illustration here, it's over $500,000. Good rate of return on money. Creditor protection, I mentioned this. What if you get bankrupt? Bankrupt, or you get sued for more than you have? They can touch your TFSA, take it away. All gone, all open to the courts. Cash value, protected. Bankruptcy, same thing. The account never goes down. This is interesting. In a tax-free savings account, now again, if we're comparing apples to apples here, if you want to get a higher rate of return than in a cash value, you're not going to be in a GIC. You're going to be in the stocks, which means your account is going to go up and it is going to go down. Your account in a cash value will never decrease within a year. Contractually. Always goes up. How's that for peace of mind? Okay. Withdrawals are 100% tax-free. So this is where it's a little bit different. TFSA, yep, you have access to that at any moment's notice. Go in, tap into it, take it out. Cash value, it's a little bit more rigorous to get access to that cash. You cannot access it necessarily in a day or two. And it can be taken tax-free in the form of loans. If you cancel your policy, you forfeit the death benefit, you just take the cash, there are tax consequences to be had on that. That's why it's called tax deferred. However, this is designed to be in place for the long term, okay? So there's plenty of ways to get that money out tax-free. Again, flexibility to withdraw tax-free savings accounts are more flexible than the cash value, so we need to take those into considerations. But even in multiple policies by year 2, you have enough cash value in there that you can withdraw and use it for premiums and do all sorts of fun stuff with it. Pick your own investments. Now, again, good or bad. In a TFSA, you get to pick your own investments. Investor behavior, if you're working on your own, can be a dangerous thing, okay? But it also could work to your benefit. You could get a lot higher rate of return. In the investment in the permanent insurance, you don't have any control of it. They control it, which again, pros and cons. Great, because you don't have to touch it. Con is that the reality is that it could earn less because they smooth out the returns than year over year than in your TFSA. But again, it's never going to go down. Management fees, also here, management fees on a tax-free savings account there will be some within the cash value. It is essentially all wrapped up in that administration that's in there, but there's no percentage of fees that gets taken off of the value of your account year after year for payment, okay? structured differently. Let's talk briefly about mortgage insurance versus personally owned insurance. So if you have a line of credit or a credit card or a bank loan or a mortgage, you need to be checking your statements. Does it say on there protection or insurance premiums or creditor protection, creditor insurance? Does it say any of those type of words? If they do, pay attention. And you may want to be canceling it after you get your own personally owned life insurance, okay? Here's why. Did you know that bank-owned insurance, the bank has full control of your insurance coverage, okay? In your own personally owned life insurance, you control. You control when you buy it, you control when you cancel it, you control if you want to increase it, if you want to change it, you have the power, okay? Mortgage insurance, coverage will decrease, but the premiums stay the same. So what we typically see is that people buy mortgage insurance that is either with the bank or with another company that offers mortgage insurance. But what's happening is that your premiums stay the same over the span of that mortgage. However, it's only covering the balance of your mortgage. Well, didn't you just pay off some? So you're actually paying the same amount for a decreasing death benefit. Obviously, on your own and life insurance, your insurance amount remains level throughout the designated period until you change it. Mortgage or creditor insurance, the bank is automatically your beneficiary. You don't have an option. Did you understand that when you have that mortgage insurance, if you die, your spouse doesn't get the money to pay off the mortgage and she can decide if she wants to pay it off or not? No, the bank gets the money. Also, watch some of them because we have we've heard and we've seen that sometimes those mortgage insurances and the clauses there that they will only actually pay half of the mortgage off. If it's jointly owned, it may be provision that you are paying assuming that if you died, the whole mortgage is going to be paid off, where in fact, if you die, only half of the mortgage is being paid off because it's jointly owned. Watch that. Obviously, in your personally owned life insurance, you choose the beneficiary. Whomever you want, we can structure it however you want. It can be that someone gets paid off for 20 years, whatever you want. On the bank-owned or the creditor insurance, underwriting is done at the time of the claim. You can be denied a death benefit because of an incomplete or inaccurate application. So if you've ever had one of these where you go to get your mortgage and they just slide the paper in front of you, which is their right and their due diligence to do to make sure the mortgage is protected. Do not get me wrong. But when you go through that, there's maybe 5 or 6 questions. Have you ever, have you ever, have you ever? You answer no to those. Did you know that they actually do a deep dive into your medical history after you're dead? Who's going to defend you after you're dead, and how much work is your spouse going to go through to get that, to prove that every aspect of your medical history was accurate enough to date at the time of application, because they didn't do all the underwriting at that time. They did at death, okay? Personally owned life insurance, all the questions are asked up front. Whether we do full medically underwritten or non-medical, whatever risk they are willing to take on at that moment of application where they say, here's your approval, here's how much you can get, here's how much the premium is, that is your contract. They have done their due diligence. They are taking on that risk. Now, obviously, if you lie deliberately on that application, lied about your age, about your medical history, then they have the right to rescind that. However, if everything's upfront, doctors are upfront, everything's disclosed, that's it. You own it. No ifs, ands, or buts. This is also where you see stories on the news where people don't get paid out. A lot of times it's because of this, okay? On mortgage or creditor insurance, your insurance is terminated when the mortgage is paid off. So what if you wanted more insurance after? Because you weren't healthy enough, right? Your insurance is terminated when the mortgage is paid off, automatically done. You don't have the option to take it to another place, to convert it to something permanent for estate planning, nothing. Obviously, personally owned, you can continue your coverage beyond when the mortgage period ends if you want it. Mortgage or creditor insurance, your coverage is terminated when you leave one bank and go to another. If you leave one bank, you have a mortgage already received and you have the creditor insurance with them, and you 5 years later, your term is up, you move to CIBC and you get the creditor insurance with them and go through the questions again, it does not port from one bank to the next. Most of them, okay? Some of them do, but most of them don't. Obviously, personally owned life insurance is portable. Doesn't matter where you go. It is attached to you, not your mortgage. Obviously, bank-owned mortgage or credit insurance does not have options to convert. So you have no options to go to permanent. And personally owned, you have a guarantee to convert to a lifetime coverage. Even if you're in poor health, you always have those options. Final note, keep this in mind. Again, can't reiterate this enough. Mortgage, credit, or insurance, the bank is paid, not your family. Your own life insurance, your family's paid. Key difference. Let's do one more comparison here. You've heard commercials about work with an insurance broker. What is the difference between a true life insurance broker and a sole bank or a sole company, let's like Primerica or London Life, who has a very limited amount of companies, if anything, more than one company that they can sell, okay, or a bank. A broker like us, who are true insurance brokers, we have access to over 15 different companies. So depending on your health, depending on your age, depending on your family situation, we might look at different companies than your neighbor. So we have access to multiple different companies. Full banker product, they usually have one series of product. We have access to full medically underwritten products or completely non-medical for cancer survivors, where a sole company usually only has access to their products, which are typically not the non-medical options, okay? Obviously, there's benefits to shopping around when your term comes due. So if you have a 10-year term and it's getting to be in year 9 and you're trying to decide, do I renew this? Do I get a new policy? There's benefits to shopping around. Term rates might have come down since you've shopped last. Benefit of a broker, again, we can shop multiple companies. The only options you typically have at a bank or a sole company is term and permanent, if they even have permanent. Again, watch for that, because a lot of those term policies, they don't have a participating whole life policy that you can change into in the future, which you may not want it now, but you might want it in the future, and having those options is going to be key. Thing to note, I can offer RBC insurance, and it would be the same price as if you went to the bank. The difference is that I'm only going to offer it if I check all my 15 companies and it's the best one, and it can be. So the value is that you still have access to some of the big banks, but not, and it's for the same pricing, but you're not losing that opportunity of shopping around. Sole banker company, one thing that you may find a lower premium than with a broker is if there is association pricing. So I've seen it where there's like the electrical engineers. They have an association plan that you could have a lower premium. However, again, keep in mind that usually means that it's tied to that association or that group and is not convertible. So that means if you leave that association or group, you're no longer eligible for that plan. Just like your work insurance. As soon as you leave work, you don't have access to that life insurance anymore unless you convert it. So while it might be lower pricing, it's not necessarily just attached to you. You now have a third party attached, which could make options complicated in the future. Full access to convertible options under a broker. Under the bank, you have limited options. Under a broker world, again, some of those amazing benefits of orphan benefits, scholarships, and all of those are only available through certain companies, which a lot of sole banks and sole companies don't have access to. Okay, so like scholarships, free family events, orphan benefits. The bank doesn't have a lot of those. This is the biggest point I want to reiterate here, okay? Consistency. Especially here at Oasis Wealth, I'm not planning on going anywhere. And we're only in the world of expanding. And it's valuable to be working with a family office who's not going anywhere. So when your term comes up for renewal, it's the same people you bought it with in the first place. They know your situation. They know your health. It's not like at the bank or at sometimes a sole company where people can come in and out very quickly, where you're dealing with someone different every time. Life insurance can be very personal. So to have that consistency of the same person in the same office can be very essential in making that right decision. How much do you need? You go anywhere else. You go out to a bank, to their insurance guys, and say, I need life insurance. Great. Here's our needs analysis. Let's calculate it. In what other world do you only insure what you need and not its full value? Let's say you own a beautiful Mercedes-Benz and you go to insure it. Do you tell your insurance guy, listen, I've got a Benz, but I don't want to pay too much, so how about we cover a value of a Honda, and that way if I lose my car, I still get a car that I need. It's not what I have, it's not my replacement, but it's just what I need, all that I need. No one would do that. When you go to get an insurance on your house, your vehicle or your house, you insure the replacement value of that property. Just like your house. You live here, but you really need this. Everything can fit there. Why are we not replacing just the need? And yet when it comes to our own lives, we get a little finicky. Okay? We don't shy away from paying premiums to replace the full value of a car or a house, which costs you money on a monthly basis. But we bark at the premiums to replace the earnings that provide for those luxuries. You pass away, no life insurance, bye-bye house, bye-bye car. All that money you put into providing for the replacement value is not going to save the fact that you still need money to pay for that, okay? Rather than a needs, we need to talk about how much it takes to replace your paychecks. In what other industry do you only seek to replace what you need and not the full value of what you lost? Doesn't happen. So let's do a quick summary. Let's do an example. What are your paychecks worth? Let's say a 35-year-old who is married, has 2 kids, earns $100,000 a year, and is planning on retiring at 65. So if we do the math backwards, he's got 30 years of working to be had, correct? 30 years of $100,000 paychecks is $3 million. That is how much he's planning on bringing home over the next 30 years. So why would we replace 100%? Because I get this argument of, A, I don't want to make the spouse rich, okay? 2, that, okay, well, life insurance is tax-free. My paychecks are taxable. You're right. So we should only replace 70 to 80% of it, I guess, then, right? Why would we replace 100% every time? Here's why. Pay raises. That's assuming he makes $100,000 a year every year for 30 years. No pay raises, no bonuses, nothing, which his family is going to spend and consume. Inflation. $3 million today is not going to be worth $3 million in 30 years. Earning potential. What if he wants to go retrain and he gets a new job that pays him $200,000? Do we account for that? No. Lifestyle changes. All of these changes. For example, if you had a person making $100,000 a year today and they got a 2% pay raise every year for 30 years, they would actually earn $4 million, not 3. So we always replace 100% of the current earnings. You don't know, it's planning for the good and the bad, right? But how much will an insurance company give you? We're talking big numbers here. There are maximums. So when we come to the maximum insurability, now there are some exceptions. There's always exceptions to the rules when we deal with underwriters. But to give you an idea, we look at a 30-year-old. So that 35-year-old would be eligible for 25 times his income. So that's $2.5 million. But we just calculated that he's actually looking at earning anywhere between $3 and $4 million. So there are safeguards as to how much an insurance company, what risk they will take on, as to what value they see on the individual. So usually the maximums are based on income levels up to when you get retired. When you're retired, it's usually 1 times your net worth or estate purposes or burial purposes, and those are easily calculated in that regards. Good thing to note, non-income earning spouses. So if you are the main breadwinner and you have a spouse who does not work, does that mean they have no earning potential or economic value to your family? Watch it. No, okay? If you think about it, in a stay-at-home mom situation, or even a part-time mom situation, something happened to mom, what's dad gonna have to hire? A cleaning lady? Maybe he's got to spend some more money on groceries because he's got to get the easy stuff. No one's there to cook and prep. Who's going to arrange for all the daycare? Are you going to have to get extra daycare? Or is dad going to take a pay cut to make sure that those kids have some more parent time because they just lost one, right? There is value in the amount of dollars on a non-earning spouse. So here's some of the maximum guidelines, okay? So someone who does not work, has no earnings per se, they can get up to $500,000 of life insurance considering how much the spouse has. So If earning spouse is $1 million, then the non-earning spouse can get up to $500,000 without any real question. Does that make sense? If the earning spouse is $500,000, then the non-earning spouse, they'll review anything from about $250,000 to $500,000 depending. If they're looking for over $500,000, they'll consider it, but usually it's 50% of whatever an income earning spouse is earning. So if an earning spouse is covered for $2 million, then a non-earning spouse would likely be eligible for $1 million, unless they're uninsurable. So if the earning spouse has some sort of medical impairment that allows them to be uninsurable, then the non-earning spouse, the stay-at-home mom or stay-at-home dad, could be eligible for more to protect the family in the event that the fact that one parent cannot be fully protected. Hope that makes sense. So in your workbook, feel free, if you've got workbook there, or just in your head even, calculate what you're worth. What's your age? When do you plan to retire? So years to retirement, E minus A. What's your current income? What's your replacement value? D times C. How much coverage do you currently have in place? Not including your work life insurance, because if you leave that job, it's gone. How much of your earnings are left unprotected? That's the key. It's not about what your family would need. You have no idea what your family would need if you're not here. Do not predetermine that for them. Give them the opportunity to succeed just as much as you're already planning on them succeeding. And then let's compare to the maximum insurability. So if I go back to the chart, if we go back here, take a look at how much you would actually be insurable for. A lot of people don't know what their maximums are. If you are not close to your maximum, I'm going to say you're underinsured, and we need to chat. Majority of people overestimate how much life insurance costs. We looked at it. $500,000 for a 35-year-old was $289 a year, less than a cable bill a month. Okay, just perspective. So calculate what your worth is. How much is left unprotected? Now, what if you're retired? You're already done. You don't have an earning potential in that regard. Why would I want life insurance when I'm already retired? Here's a few reasons. Estate protection. Someone's got to pay for the funeral. The average funeral costs between $7,000 and $8,000 a year, right? Or obviously a one-time expense, $7,000 to $8,000. And in that $7,000 to $8,000, that does not account for a spouse taking time off work, or a spouse just taking time from their day-to-day living, okay? It doesn't account for children having to take time off work in order to, maybe they have to fly in, right? Maybe they need to have a hotel stay. Who's going to pay for the catering at the wake? Who's going to pay for all the extra? There's a lot of little expenses that come up. Again, extra child. I don't know. There's so many unknowns that easily you just ring the card and you don't think about it, right? Final debts. Are there going to be some debts on the book when you pass away? It's not the end of the world, and it's happening to more and more retirees. But then if we're going to do that, we better have a game plan to make sure that our loved ones aren't stuck with them. Final taxes on registered accounts or taxable assets. If you're single, you pass away, let's say they're 30 years old, they pass away, they've got $200,000 sitting in an RSP. Depending on the time of year, there could be $80,000, $90,000, $90,000 in taxes to pay. Who's paying for that? Kids? Grandkids? It'll come out of the accounts eventually, but do you know how long it takes to settle an estate? Especially if there's no designated beneficiaries. Take a very long time. And by the time they get the money, some bills have already come due. You own a home, there's going to be probate on it, right? Any other final expense wishes, such as reserving an inheritance guarantee. Okay, so what this means is that, let's say someone's got, they've got some TFSAs, they've got a RIF account by the time they're retired, or they've got some old Bell stocks that they're just saving for the grandkids. Okay, all of those are typically going to be in the market. So it means they're going to go up, they're going to go down, and you're not going to know exactly how much your grandkids or your kids are going to get. It's a hit or miss. Plus, what if you need the money? What if something happens? there's no guarantee to that inheritance. And now, not that our kids are going to need the money, but I have seen that people, as they get older, they get sentimental and they want to leave something. So prepare for that. By having some type of life insurance on the books, you're reserving an inheritance guaranteed. Not having to think about it, okay? It's also the best way to pass on assets and legacy. Okay, so for example, if a retiree has more RIF income than required for lifestyle, because once you convert to a RIF at age 71, there's minimums they have to take out year after year. And it's happened where the minimum income you have to take out is more than they need for their lifestyle at that time. Okay. Rather than put into a TFSA at risk, or at most maybe at a 1 or 2% GIC, transfer to life insurance, have a guaranteed legacy that would be passed on to the kids within a matter of a week or two of passing away. Easy, tax-free money, okay? If you're not planning on spending it anyway, secure it. Make it easy to pass on. Don't give headaches, okay? The other thing we can do with life insurance, which people don't realize sometimes, is especially when it comes to legacy, we can take a life insurance and we can say, when I die, don't give it to my beneficiaries in a lump sum check. Give it to them in 10 little checks over 10 years, or 120 checks. So give them a check every month for 10 years. Remember grandma, remember grandpa, okay? Not just in a lump sum that you'd be worried that they would squander. There's lots of options, okay? So I'm gonna leave you with this, maybe 2 questions. Do you have a gap in your protection? Are you protecting the full value of your house and your car, but not yourself? Okay. Or 2, are you retired and maybe get a little sentimental and want to ensure that there's something in it for an inheritance that's guaranteed, that's not at the whims of the market? Or 3 questions. Okay, 3rd question. Have you really considered what cash value and what life insurance can do for your retirement? Okay. It's really 3 stages when I see this life insurance thing. We've got term, when we need something temporary for young families, mortgages, okay? Then there's that planning for retirement. Sweet spot. Sweet spot that you can do so much with what you have, okay? And finally, for that estate protection, that inheritance that's passing on. In any 3 of those areas of your life, we need to talk. We need to make sure if things are set up properly, beneficiaries are set up properly, how it's going to be dispersed and set up properly, your options, okay? Again, all of our information is listed below. And again, if you have any questions or any comments, let us know. We are always open and available, and would love to meet you and to sit down and see if we can shine some light on what you might have in your financial junk drawer called life insurance. Have a great day.